Hey everyone, Greg here with Mark. We are doing an impromptu update for you regarding performance of your accounts. Given what's happening right now with markets and all of the uncertainty that's out there, Trump's trade policies and the impact that they're having. So we're going to give you some insights into your portfolio performance, give you some insights into how your portfolio performed in 2008 and what we think you can expect if things get better or worse using historical information regarding markets. So let's go. So where are we as of this morning? Well, as of this morning, the various models that we have all clients in, every model unfortunately is down, but you can see that our more conservative models are not doing too bad. Our very conservative portfolio, which is 70 to 80% bonds with a chunk of gold and 20-ish% stocks, 20 to 25% stocks, that's only down about 1%. The conservative portfolio, that's closer to around 40 to 50% stocks. That's down 3.5%. Our moderate portfolio, which has around 65% stocks, that's down 5.5%. The growth portfolio, which is around 85% stocks, that's down 9.5%. And our aggressive growth portfolio, that's only down about 11%. So why is that? Why are we down less than what the headlines are saying? Well, that's because, again, I like to stress this. You have both stocks and bonds. 90% of our clients, 90% of what you're in are either the very conservative, moderate, or growth models. They have a bond allocation there, but they're also globally diversified. So you don't just own American stocks, US stocks. That makes up about half of your portfolio. But the other half is typically in Canadian stocks, international stocks, emerging market stocks, Asian stocks, and those indices, those stocks have done substantially better than US stocks, at least on a year-to-date basis. So they are faring better. International stocks, Europe, those are actually the strongest, that's the strongest performing, or those are the strongest performing markets. Those are actually, I don't even know if they're down. Some of those indices are still up 1 or 2% on a year-to-date basis. So it's nice to be globally diversified. This is why we're globally diversified, because we don't want to put all of our eggs in one basket, and it is paying dividends right now in terms of our performance.
Greg, just a point. I find it interesting that if you lump together the first 4 months of this year and all of last year, almost every portfolio is up about 9%. They're almost all identical.
Yeah. So everyone, it pays in some cases not to take on risk, because when we do have a little bit of a decline, in the end, it's mid decline. In the end, you end up faring better if you have more risk in your portfolio. But while we experience these declines, you have this point, this crossover point, and we're kind of at that crossover point right now. But I'm not we're not overly concerned. But I did want to just make sure that everyone understands the total level of risk that is inside your portfolio. And I'm not saying this to scare you at all, but I just want everyone to understand that your portfolio, if you are in a more conservative model, can go down a bit more than how much it's already gone down. And all of these declines, again, are temporary, and eventually everything does come back. But here is how much each of our models went down in the global financial crisis. And the peak to trough of the global financial crisis, it started October, November of 2007, and it bottomed beginning of March of 2009. It was about 16 months total. From peak to trough, the very conservative portfolio was down 8, all the way to the aggressive model It was down 52%. Now, it took about 18-ish months, 18, 19 months for all of these models to be positive again, for us to get back to where we were in November of 2007. But you know, this type of decline that we're seeing, it's not what we're expecting here. Okay. This was the worst decline since the Great Depression. And there are different mechanisms in place that I think, and different circumstances in place, um, that are going to lead us away from this type of decline. Okay. I'm not saying that we won't go down more. I actually think that we potentially haven't hit the bottom yet, but this is like worst case scenario. Okay. And the total time frame is, 3-ish years, 3.5 years to go from peak to trough, to be right back to where we were, and then to be making new highs again in subsequent years. So what's going on here? Well, the big issue is that I'm going to use some colorful language and just try to be genuine with you people. I am not a Trump fan at all. I do believe in some of his policies. I think there are some things that some of the things that he's doing are not bad. They're actually good. Getting countries to start spending more towards their military to be more self-sufficient there, less reliance on the US. There are some good things there with respect to NATO spending. But when it comes to his take on the economy and who he's following and the advice that he's taking, it doesn't make any sense. And when he's being asked questions in his various pressers, or if he's just being interviewed after getting off of a jet or an airplane or coming back from a golf tournament, or the various times he golfs, like he sounds like an idiot. It doesn't make any sense. When he's talking, seems to continuously be confusing trade deficits and fiscal deficits. And with the position of the US consumer and the evolution of Western democracies, most Westernized countries right now are moving towards being in trade deficits. And that's because global manufacturing has moved to developing countries where things can be done at a fraction of the cost. And all of these developed countries like this because that means that we get to buy cheap goods. And that's okay. That leads to a trade deficit. I heard I heard someone on BNN just kind of give an example, an everyday life example about trade deficits and how stupid it is to think that a trade deficit is bad. When you go and get your hair cut, or say go do some grooming, you go to a car wash, you go pay for something, you're in a trade deficit with that person. So I am in a trade deficit with my barber right now by going and paying for a service to get my hair cut. Like that's the way it should be thought about, to use very basic language. And for some reason, Trump thinks that by changing the trade deficit, by forcing countries, by forcing the U.S. not to be in a trade deficit, by forcing countries to start buying U.S. goods, that's going to translate into a positive fiscal deficit, which is all about how much the U.S. spends on itself within its country. It's not how it works. They're not going to be taking these trade deficit dollars and potentially using them for fiscal reasons to help the actual populace. What they're trying to do is they're trying to cut taxes. They're trying to justify a means to cutting taxes for the richest people. It's not going to support the overall economy. It's going to support the billionaires. That's it. So anyway, I get upset because the narrative that is coming out of the right, of letting this guy do what it is he needs to do to try to bring back this manufacturing, that no one is going to in the States want to work these jobs. it is not, it's not a good idea. It is going to potentially crash the economy if he does, if he's actually able to fulfill this. Mark, I don't know. You've got some good thoughts on this. What's your take on what he's doing right now? And then I'll jump to the next slide where we're going to speculate on what happens next.
Well, Greg, it's easy for me to say this, but I agree with you. You know, this strategy that Trump is pushing is extremely dangerous, and it's not practical. And it's hard to make sense of it. First of all, the numbers he's thrown around are not factual. And, you know, he throws around numbers of a $250 billion negative trade deficit with Canada. Well, in actual fact, if you take oil out of the picture, we have a trade deficit with the Americans of about 30, 40, $50 billion.
Yeah.
And the only reason we run a surplus when you add oil back in is because we're not able to export most of our oil to the coast and sell it somewhere else at full price. We ship it down south to the States at about a $20 a barrel discount, and that makes the refineries down there, that triples their profit margins. They make a fortune off our oil.
Yep.
So when you look at the Canada-US relationship with trade, it's very hard to see how that's negative for the Americans. And anyways, this $250 billion number for the world is not significant. And as you said, it's not negative either. There is no way that we can bring back some of these goods that are produced at $3 an hour in Vietnam or $6 an hour in China or $2 an hour in Cambodia. Americans don't want to work for $2 an hour.
Exactly.
And it's just not even practical to think about bringing this manufacturing back, because no one wants to, like, we already pay $150 for Nike running shoes, and if they all get made in the States, they're going to be $250.
Not to mention, if you look at how big of a workforce you need if you start onshoring some of this manufacturing, like the U.S. is at 4.6% unemployment right now. They don't have enough able bodies to be able to man the equipment in these new factories to be able to start this mass amount of production. Like, it doesn't make any sense. Like,
well, as Trump pushes out many of the immigrants, and his solution is to reduce the hiring age to 14.
Yeah, that's what they did in Florida. Allowed 12-year-olds to work 14-hour shifts as part of a new state law that DeSantis placed to make up for the fact that they were exporting so much labor. They're losing so much labor through ICE and lack of immigrants now coming in, or immigration now coming in. Now, all of the people who are currently working there, let's get your kids on board working for below minimum wage, and let's start child labor again, and let's get rid of all the child labor protection laws that are in there. It's crazy. It's absolutely crazy.
It doesn't look good, Greg, and it doesn't look like it's going to work. It's not going to work, and so we hopefully, we'll get calmer heads shortly, and the American people, Trump, will make some adjustments quickly and become, and this whole thing gets yeah.
I mean, so if the numbers don't make any sense, if trying to onshore doesn't make any sense, if it goes against what most Americans are looking for, they're looking for lower prices, they're looking for stability, then what is Trump trying to do? Well, I think what he's trying to do is he's trying to extort using mafia-like tactics all of these smaller countries, as well as China, and he's seeing how far he can push the envelope. And I think this is something he might have done in business practice before. If you've ever heard someone describe about what Trump did in the art of the deal, part of it was acting like a crazy person. So you're unpredictable. There are actually economic theories out there about if you're an irrational actor approaching a rational actor, that you can set the other person off guard and win. You're more likely to win in a trade dispute because the other side can't predict what you're going to do. And it's a huge disadvantage for them. So, like, I don't know if this is like some sort of like 4D, 5D chess move, and he's, or if he's just crazy. But what we are starting to see as of today is we're starting to see the billionaires who supported him in his campaigning by dumping tens of millions, and in some cases, like Elon, hundreds of millions into his campaign. They're starting to turn on him, and that's, I mean, it's obviously a good thing. I think it has an impact. Today the market was up. It looks like it might finish the day down. Trump's about to impose potentially a 50% tariff. I think what we're going to start to see is, if we have if the market continues to decline further at the rate at which we've seen it decline, we are going to see impeachment happen sooner rather than later. So we've already seen the Senate, about 7 or 8 senators in the states, band with Democrats to launch a bill that goes to the House, potentially impeaching him. I think it needs 280 votes or something like that in the House. There's 210 or 213 or 214 Democrats that will for sure vote it. Then they got to find 60 or 70 Republicans to vote on it. There's about 50 that are non-MAGA that will probably vote on it. Then they got to find 10 to 20 MAGA people to vote on it, and that's going to be a challenge. So it might be dead before it arrives, but it's happening, right? We're starting to see the resistance build. Now, if he does, that's one potential scenario where if he just lets the markets continue to go in free fall, then yeah, he's going to get impeached. That's what's going to happen. The other potential scenario is he's got some sort of number in mind where he's going to course correct himself. Like he came out 2 months ago saying he was never going to think differently on Canada and the United or Mexico with respect to tariffs, and they were going in, and then all of a sudden a day later he delays it 30 days. I think because he's fickle, I think that it's very possible if we have 1 or 2 more bad days, say we go down another 5, 6, 7, 8%, global markets go down that much, that he says something and the markets course correct very, very quickly. That's another potential scenario. The third potential scenario is we have this drawn out 7 to 12, 13, 14 months of being at this current level and maybe dipping a little bit, then, coming back. And it isn't until the midterm elections start ramping up in the States that the polling numbers really start to show that the Republicans are about to get wiped out. And then his entire base just turns on him then. That would suck because that would mean, almost a full year of his policies. And I don't know what that will mean long-term for the markets. Okay. I think that's like a 1 in 100 chance of happening. I don't think that's very likely, very unlikely to happen, but that would be like a worst case scenario. Then potentially we would see, that 2008, 2009 correction, that type of volatility, and, a 3-year window from peak to trough, us getting back to where we were before we start making new highs again. I don't think that's going to happen because I've already seen how quickly he can pivot and change his mind. But it's what we have to potentially look out for. So for now, though, for everybody who we have invested, the portfolios are doing exactly what we want them to do, and we're not recommending any changes. Well, here's some good news. Let's end on some good news. So there is a financial analyst out of the States who is a big data nerd. Reference to him is Charlie Bilello here, and he posts on social media, historical returns, and then he looks at volatility, and he shows how the market performs after these big bouts of volatility. Well, he looked at the 2-day decline that we just saw last week, where markets were down, 5% in back-to-back days. The last time we saw this type of volatility was in the global financial crisis. We also saw some of this. Well, not the last time, it was actually in the COVID sell-off. But most of those days happened in the global financial crisis. And what followed on the 1 year was a 30, 40, 50% increase in the S&P 500. If you look to 3 years, it's up 40, 50%. In 5 years, the S&P in most cases has more than doubled. So that's good. I mean, most of us have a longer than 3 to 5 year window for this money. If you're 75 years old, odds are you're going to be living, barring health, until you're at least 90. So that's a 15-year window. So, no real issues there, especially if you're younger. We should expect to see some forward-looking great returns in all stocks. And here's another way that he expressed stock market returns, looking at something called the volatility index, the VIX. He had, as of April 4th, the volatility index as of April 6th had actually spiked closer to between 50 and 60. So this is where volatility lies. If you see where I'm kind of dragging my mouse. And if you look at forward returns, with this level of volatility, 3-4 years out, most of the time markets are up somewhere between 50 to 100%. So they'll have more than doubled in some cases, and 5 years out, in some cases they've more than doubled or tripled. So we're good. I mean, we're not worried at all. It's annoying to have this level of volatility. What I think everyone should do is, it's tough because, tied in there was attacks on our sovereignty, which I think forced everyone to hyper focus on what he was saying. But it seems like that rhetoric has calmed down a little bit. And Carney, who had a conversation with him, has calmed him from talking about invading Canada or Canada becoming a 51st state. So that's all good news. I think what everyone should do is just stay away from the news, stay away from the headlines, don't pay attention to it, because if you do pay attention to it, the emotional response will be to panic if things do get worse. And I actually do think we're going to see a bit more downside volatility, but just know that it's temporary. And if we just continue to hold, like if we have a 2008, 2009 market type correction, a year and a half later, your money's we're basically back to where we were. And then we start making new highs again. It's all temporary. I'm not overly concerned. Mark's not overly concerned. Mark, you're not overly concerned, right?
Right. Correct. And Greg, I just want to point out to everyone, as you said, it gets emotional if you follow this stuff every day, because it's all over the news, everywhere. TV, radio, social media. You can't get away from it. Especially the U.S. media. They will work this 24 hours a day in and day out, and it becomes depressing. And it's a complete waste of time. And what we want to hopefully try, one of the biggest values Greg and I bring to the business, any good financial advisor brings to their business, is in helping their clients try to stay calm and try to make rational, intelligent decisions, not emotional decisions. What we don't want is, the market dropping we don't want the market dropping, period. But, it does drop, and we do have corrections, and we do have bear markets. And the point is, if you panic anywhere towards the bottom of the cycle and crystallize your losses, then what do? Well, today you go into a T-bill fund or a bank high interest fund at 1.5%. And then you miss a 10, 15, 20, 30, 40% recovery. Yeah. That's what we don't want.
Yeah, that's 40, 50, 60% within a year. And then you miss the subsequent returns because there's potentially some headlines that come out there. You're still afraid. And then you get in 5 years later when the market is up 100 to 200%. And exactly. You've completely shot yourself in the foot. All you're doing at that juncture is you are buying high. You are selling low and buying high. The opposite of what we're trying to do and what you're trying to do. So thanks, Mark. No, I appreciate your perspective. I hope this helped. We're not, again, expecting what happened in 2008, 2009 to happen here. It's looking like the recovery, when it does happen, everything is kind of spring loaded. We already saw a whole bunch of money come back into the market yesterday and a bit in today, just on positive headline news. And there's a fake headline that came out that you saw 4, 5, 6 trillion come back into the market very quickly. So I think, the moment there is a bit of certainty and Trump changes his mind at some point, or it's changed for him, likely in the near future, that we'll see some huge market rally days, and we'll all be breathing a little bit easier. Okay. Thank you for listening to our update. If at any point you want to talk to either myself or Mark, we're always happy to discuss portfolio performance with respect to your financial plan. And if you want to make any changes, of course, it's your money. We're always happy to oblige, but we're recommending everyone stay the course. And thank you for tuning in and listening to our impromptu update. Hope you're well.
Bye, everyone.